Are you approaching 55 or already past it? Then you may be able to leave your job and access money from your retirement account without penalties. It's called the Rule of 55. It's a rule the IRS deliberately built into the tax code, and most people have never heard of it. While many continue burning out at work, convincing themselves they have no choice, this option simply sits there unused. Today, I'll explain exactly how it works, who qualifies, and why waiting until 59 and a half could end up costing you more than you think.
My name is Marcus. I've spent hundreds of hours analyzing tax strategies to help you reclaim your best years. If you want to leave work earlier, hit like, subscribe to the channel, and let's begin. Let's get into the mechanics, because understanding exactly how this works is what separates the people who use it wisely from the ones who accidentally disqualify themselves. The Rule of 55 applies to your 401k or 403b from your current employer, the job you're leaving. That's it. Not your IRA, not the 401k from the company you worked at a decade ago. Your current plan. When you separate from your employer, whether that's retirement, a resignation, or even a layoff, that separation triggers your eligibility. But here's the critical piece most people miss. The money has to stay inside that employer plan. The moment you roll it into an IRA, the Rule of 55 evaporates. Gone. You'd be back to waiting until 59 and a half or facing that penalty. Now, if you have old 401ks sitting around from previous jobs, some plans will actually let you roll those into your current employer's plan before you separate. That consolidation move can bring more of your savings under the umbrella of this rule, but it has to happen before you leave. So talk to your HR department or plan administrator now, not later. Let's talk about the guardrails, because this is where people get tripped up. First, not every employer plan allows Rule of 55 withdrawals. The IRS permits it, but your specific plan has to allow it too. That's a call you need to make before you hand in your notice. Second, if your savings are already sitting in an IRA, the Rule of 55 doesn't apply, but there is an alternative called 72T, or Substantially Equal Periodic Payments. This option lets you access IRA funds early through a fixed withdrawal schedule. The catch? You have to commit to that schedule for at least 5 years or until you hit 59 and a half, whichever comes later. And you cannot change it midstream. It's like launching a rocket. Once you ignite, you're committed to the trajectory. These strategies get complicated fast, so if you're considering the 72T route, please work with a CPA or financial planner. The Rule of 55 is far more flexible, which is exactly what makes it so powerful for the right person at the right time.
Now here's the part of this conversation that doesn't get nearly enough attention. The money side is only half the equation. The other half is your body. The decade between 55 and 65 is what I call your green light years. This is statistically the phase of retirement where your health, your mobility, and your energy are still firing on all cylinders. You can hike that trail. You can take that international trip. You can start that business you've been sketching on napkins for 15 years. Researchers have documented what's known as the retirement spending curve. People burn rocket fuel in the early years of retirement on experiences, travel, and adventures. Then spending naturally levels off as interests shift and energy dips. Then it climbs again later, driven by healthcare costs. The shape of that curve is telling you something important. The life you imagine living in retirement is most achievable in those early years. Waiting until 65 or 67 doesn't just cost you money, it costs you the version of yourself that could have actually enjoyed it most. Now, let's be real about the trade-off, because there absolutely is one and you need to look at it clearly. Every dollar you pull out of your 401k early is a snowball you're lifting off the hill before it had a chance to roll. $100,000 invested at 6% for 10 more years nearly doubles. That's real. Working longer means more contributions, more compounding, and a shorter retirement to fund. But here's the reframe. Working longer also costs something that never shows up on a spreadsheet. It costs time. It costs health. It costs the green light years. So this isn't about recklessly raiding your retirement account the day you turn 55. It's about running the actual numbers, your projected expenses, your income sources, your health coverage gap, and making a fully informed decision rather than defaulting to, "I'll just keep working because that's what you do."
So how do you actually prepare for this? Start by mapping your expenses honestly. Housing, transportation, food, property taxes even after the mortgage is gone, and inflation adjustments across the board. Then layer in healthcare. This is the big one. When you leave your job, your employer coverage goes with it, and Medicare doesn't kick in until 65. That gap needs a plan. I've linked a free healthcare cost calculator in the description below. Use it to get a real number before you make any decisions. That gap between 55 and 65 is expensive, and you need to know exactly what you're walking into. On the investment side, consider that a 30 to 40-year retirement is like driving cross-country on a single tank of gas. You cannot afford to be too conservative too early. A heavier stock allocation, think 80-20 or even 85-15, may be necessary to keep pace with inflation over that runway. And finally, think about taxes strategically. If you're withdrawing heavily from a 401k to live on, those dollars count as ordinary income, which can fill your tax bracket fast and limit your ability to do Roth conversions in those valuable low-income years. Plan the glass carefully. You want to fill it without letting it overflow. Here's what I want you to walk away with today. The rule of 55 is not a trick, it's not reckless, it's a tool, one the IRS deliberately created, and it may be exactly the bridge you need between burnout and the life you actually want to live. This isn't all or nothing either. You could take a year off, work part-time, launch something new, or return to work later. The rule just gives you options when options feel scarce. So if you're approaching 55 and you're exhausted, or you're watching your green light years tick by from behind a desk, this is worth understanding deeply. Call your HR department, talk to a financial planner, run the numbers, and remember, you can rebuild a portfolio. You cannot get back time. If this video opened a door for you, hit that like button and subscribe, because there's a lot more where this came from. I'll see you in the next one.